Greetings again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is June 19th, 2020, and we have several topics to discuss. This is our Friday's Insights, and we'll set up the week ahead. Here at Blanke Schein Wealth Management, we believe that information is power, and our goal is to provide our clients, friends, and family with real-time, relevant, market-related information. Our process creates smart and purposeful financial decisions that improve your life, your family's life, and the community you care so much about. Today is an audio-only update, and let's get right into our three topics of the day. We have options expiration for the S&P 500, as well as rebalancing today. So all that means is you got about $1.8 trillion of S&P options are ready to expire, making it the third largest non-December expiration ever. What that means is a lot of volatility. So today's Friday trading day. We could see a lot of trading day. In fact, the rebalancing may force about $48 billion worth of trades, up from $60 billion over the last 6 months ago, according to S&P Jones estimate. Now, what that actually means and translates into, as we manage portfolios for our clients, we constantly rebalance, just like the S&P 500 does. And so over the last 6 months, you've seen a lot of market volatility where bonds have appreciated because interest rates have gone down. So your bond portfolio more than likely has appreciated, and the stock portfolio, while the market's been volatile, it could be a little bit underweight or gone down a little bit. Therefore, the rebalancing occurs to keep you back to your original asset allocation. So as we do that for clients, so in this case, it would be selling some fixed income and buying some equities for rebalancing, getting you back to like a 50% allocation or 60-40, whatever you happen to be. That's what the rebalancing comes in. So the indices do that as well as pension funds and institutions. So you're gonna see a lot of volatility, but that's what's happening in the market today. Well, here we go again, US and China. Once again, this is going to be a consistent theme. As I talk about, you always want to pay attention to the actions, not the rhetoric. And here we go. President Donald Trump on Thursday renewed his threat to cut ties with China just a day after the diplomats met in Hawaii. You can't make this up, but this is important to pay attention to, that the US and China relations have reached their lowest point in the years of the Trump administration. But that being said, there's going to be heightened rhetoric from the Trump administration because this is an election year. However, I firmly believe that rhetoric wouldn't be so bolsterous, if you will, or bold, if he didn't have a good indication from when they sat down earlier this week. So it's sort of like a gamesmanship. Unfortunately, Trump sees that's the way he wants to play this. But you want to watch the actions, what they actually do versus the rhetoric that's playing out. And how do we know this? Well, there's multiple points of friction that we monitor in the economy and in markets. And ultimately, you want to watch the dollar and yuan. And so there's zero stress right now. In fact, it would be spiking if the markets thought that this was anything but noise. And actually, it's not spiking at all. So we in the investment world watch the indices of some specific barometers that are sort of lights on the dashboard. And they sort of act up or cause us of concern in the financial investment market. In this case, it would be the dollar versus yuan. But there's zero stress there. So right now, it's just headlines again. But keep in mind that China also has to accelerate their plans for purchasing their farm goods to comply with Phase 1 China trade deal following talks in Hawaii this week. So they said they would do that. So we want to watch that they actually follow through on that, because that's a big action. It's over $4 billion in the first 4 months of the year that they have to do that. So U.S. Agricultural Department, as well as our U.S. farmers, are depending upon that. And so that is one of the goals of the trade deal. So we have to make certain that that actually happens. That's a big indicator. If China backs away from the table and doesn't do that, then we have bigger issues. So that's the China-U.S. update. But so far, so good. And there's really not stress in the financial markets as a result of the words that are out there. Last topic of the day, more cases could equal additional stimulus. Now, we know that the House passed $3 trillion that the Senate is looking at right now, and we could get some sort of agreement and passing of another round of stimulus by mid-July. That being said, we already have $7 trillion in the system from Federal Reserve monetary policy and fiscal policy, what Congress has already done working together, $7 trillion in the system itself by way of liquidity or additional dollars. As evidence in the M2 money supply, businesses and individuals have money in the bank. And that's where we see what's most critical is as we reopen, the markets are looking that we don't close down again. And I don't think there's going to be signs of that, even though while numbers of new cases in Florida, Arizona, and California have all hit record daily highs, authorities have so far not shown any signs of putting lockdown measures in place again. And that's a positive for the markets. While California authorities have basically said, listen, we want everyone to wear masks outside. That's a positive sort of proactive approach and thoughtful approach that the markets like versus shutting everyone down and keeping everyone quarantined again. So that's a positive for the market. But ultimately, if you see a little spike in cases that we're seeing, and again, those are regionally, the market is looking at this because the Pacific Northwest and the Northeast versus the South and the West are all on the downslope, and they don't see spikes right now. So that's a very positive. So the market's looking through this data very clearly, and it's looking through the headlines. So we do have spike in cases, but they're regionally spiking at this moment in time. It's very positive because that means that we can not shut down the entire United States. It's just fractions and sections and regions of the economy. So that's a positive. And as we see spikes in cases, we could also see additional stimulus because we're not out of the woods from unemployment to a few other things for small businesses. So we're going to see as those cases spike, it's going to basically signal to Congress that additional stimulus is needed, which we will see. But the higher the hot spots or the greater the hot spots, the greater the stimulus. So that stimulus will work its way back into the marketplace. And that's what the market's looking at once again. So unfortunately, it's kind of strange the way the market sees it. But the more cases equal more stimulus. Therefore, the economy is going to be propelled by an additional more than the $7 trillion that's already in there. So that's what the market pays attention to. And it's literally paying attention to that right now. So we're going to see that play out. That's it. That's our update for today on Friday. We appreciate you guys listening and tuning in. If you have friends and family or anybody out there you care about and you want them to have additional financial knowledge, please share and like and subscribe yourself. Take care. Have a great weekend.